Good afternoon. It's Friday, May 22nd. I'm Matt Moklestad, lead advisor at Foster Group, and I'm filling in for Kent Kramer this week. This is our weekly market update where we spend a little time talking about news over the past week regarding markets and the economy, and then spend a little time talking about a special topic. And today I'll be talking about what low interest rates mean for investors. And for those of you who don't know who Foster Group is, we are a registered investment advisory firm, and we have the privilege of serving over 1,400 clients across the United States. So looking at news for the week, there's a few things here. The first is that on Monday, markets started higher with hopeful developments surrounding a potential coronavirus vaccine from the company Moderna. That was viewed as a very favorable development, and stock markets are up 3+% on Monday. Another piece of good news is that weekly mortgage applications were just 1.5% lower than a year ago, and that's a much better reading than it has been over the last couple of weeks, which points to a recovery in home purchases. Workers filed for another 2.4 million unemployment claims last week, which is still a record number, but continues to trend down from weeks prior. All 50 states have begun to reopen with varying degrees. And lastly, towards the end of the week, there's been some renewed US-China tensions surrounding new national security laws in Hong Kong. One other piece of news was that on Sunday, May 17th, 60 Minutes aired an interview with Federal Reserve Chair Jerome Powell. And he was directly asked a question about what he thinks about negative interest rate policy in the United States. And this was his response. He says, quote, "I continue to think, and my colleagues on the Federal Open Market Committee continue to think, that negative interest rates is probably not an appropriate or useful policy for us here in the United States." And then he goes on to say that evidence on whether it helps is quite mixed. So it seems as though he made it pretty clear that the United States is not headed to negative interest rate policy like other countries in Europe. Reviewing the markets, major stock market indices in the US and overseas were positive for the week and are still in positive territory for the quarter. And bonds saw a relatively calm week. Government yields remained mostly steady and corporate yields fell modestly. If we look at actual index returns over the last 5 days, you'll see in the light blue, the S&P 500. In the purple is international stock markets. And then that orange line is the US bond market. And you can see that things started off very good this week. It kind of treaded water and then lost a little ground yesterday, and will end the week positive just over 2.5% for stock markets. So that sums up the week, and I wanted to spend just a little more time talking about that orange line, the bond market, and specifically interest rates. As many of you know, interest rates have fallen to historic lows this year. I thought I'd just address the question on what do low interest rates mean for investors? And to start and provide a little bit of context, this is a look at the 10-year Treasury rate going back to the beginning of 2016. What it shows is simply just a US government issued Treasury bond with a 10-year maturity, what its rate has been over time. And I've always liked this chart just because it provides a nice overview of what the general interest rate environment is at these points in time. And you can see that the 10-year Treasury, it yielded 1.92% at the end of last year in 12/31. So that was just above previous lows we saw in mid-2016, where it yielded roughly 1.37%, but a little lower than where it was in November of 2018, where it yielded about 3.25. So we started at 1.92, and then rates really took a nosedive starting in mid to late February of this year to new record lows, where the 10-year Treasury hit an all-time low of 31 basis points intraday on March 9th. It has since stabilized to some degree, and it closed at 64 basis points on May 15th. What we saw similarly across the Treasury yield curve, and this is what this slide shows here. The green line shows the yield curve as of 12/31 of 2019, and the dark blue line towards the bottom shows the Treasury yield curve as of May 15th. And what these lines do is they simply just plot yields on different treasury bonds with different maturities, which are the numbers you see in the table below. We already talked about the 10-year treasury rate there. If you look at the 3-month treasury, you'll see that it started or ended last year at 1.55% annualized, and then it fell down to 12 basis points here this year. So when you think about the question, so what do low interest rates mean for investors? Well, the return you receive as a bond investor, it really depends on the initial yield at purchase, and then any subsequent changes in market interest rates going forward. So generally, lower bond yields today point to lower returns in the future just simply due to less income. And the only way to potentially earn above that initial yield is if market interest rates fall further. So technically, interest rates could fall further than they are now. A year ago, no one thought that we would be where we are today. But generally speaking, with being at record low levels, bond investors or fixed income investors should probably expect lower returns going forward. We've only talked about the treasury market so far. Fortunately, there are other high quality fixed income markets that could offer higher returns to investors than the yields they see here. To provide an example, this is a chart. There's a lot going on here, so I boxed in a couple areas to focus on. One is the US Treasury broad market. These are averages on broad markets. And if you look at the US Treasury, it yielded 50 basis points or 0.5% as of May 15th. And then looking down at the US corporate investment grade market, it yielded 2.71% as of May 15th. So roughly a 2% spread above treasuries. Historically, investors have been able to receive a spread or an increased yield over treasuries and things like corporate bonds because of the additional risk involved in investing in a corporate bond. US Treasury bonds are really viewed to be very safe, one of the safest investments because it's backed by the US government and its taxing authority. And US corporate bonds have default risk. So the risk of default on either an interest payment or the repayment of the principal. Surprisingly, if you look at historical default rates, they've actually been fairly low. And this is a look at historical default rates for the global corporate bond market. We have the highest quality AAA at the top down to the lowest quality at the bottom. And you'll see, for example, that a single A rated company historically has had a default rate of 0.05%. So fairly low. One thing to point out though is that before a company or a bond would default, they would usually be downgraded before that happens or migrate lower. So it's really important to monitor your investments. But overall, if you look at this graph going back the last 15 years, it's probably about what you would expect. I have the US Treasury market in the light blue, the US corporate investment grade market in the green, and you can see that over time, both have just kind of chugged along with minimal volatility. One thing you will notice is that in periods where stock markets are drawing down or under pressure, that corporate bonds, that green line, also can show a little bit of stress during those periods. You'll see that in the middle left-hand part of the screen, and then towards the top right, most recently in mid to late March. And Kent Kramer actually, he addresses that in our March 20th video. But overall, if compared to the broad stock market, both treasuries and corporate bonds can offer some nice diversification to a more volatile stock market. I would say that within a portfolio, both treasuries and corporate bonds have a place in a portfolio. Probably don't want to own all treasuries right now, but you probably don't want to only own corporates either. Diversification is important. So to sum this all up, here's our quote for the week. It's from Ian Wilson. He is a former chairman of GE. And he says that no amount of sophistication is going to allay the fact that all your knowledge is about the past and all your decisions are about the future. Whenever I read this quote, it's always humbling because although I'd love to be able to say that I know what's going to happen with interest rates or markets, the reality is that no one truly knows the future. So we don't know the future, but we can use history as our guide. And what we know about today and our knowledge about the past continue to tell us that bonds play an important role in the portfolio and that diversification is important. That sums it up for the week. Thank you for taking the time to listen. If you have any comments or questions, For the Foster Group team, please email us at the email you see on your screen. If you want to learn more about our firm, please visit our website. And if you'd like to request a meeting with an advisor, please visit our website at the lower link on your screen. Thanks so much.